morning. Welcome to Dornbush Download 125. Good morning, Andrew. They're ticking on by, aren't they?
Oh, 100 is just like yesterday. You know, 100, Dornbush Download 100, was the most viewed and interacted download, not because of my ugly mug, John Dornbush. People wanted to hear about Dorney's story and, you know, being a school teacher and, you know, everything that he's done. So whether 125 gets to those lofty heights based on the material that we've just been discussing, don't think it's going to happen.
Not likely. but no, I've watched that one a couple of times, yeah, and it's really interesting getting some of his insight as to how how it all sort of happened in the good old days, so to speak.
We've worked with him for 13 years, and that's like I'm standing there listening to him going, wow, where have you been hiding all this information? 30 years for Dorney this year. Yeah. 30 years.
That's a life sentence.
1.5 life sentences. Anyway, we're going to turn this into the John Dornbush affection show. Profit reporting season rolling on with abandon. So we've got 3 for you today for our Dornbush Download viewers. We've got Telstra, we've got BHP, and then maybe touching on a couple of the laggards, maybe ones that haven't been performing so well, and 2 that immediately came to mind was Brambles and also Wally Parsons. So which one do you want to take first?
Oh, well, we probably should have a look at Telstra maybe. We've got a fair few clients in Telstra, and Telstra has been held for numerous years, mainly as a dividend stock, but of course a lot of people participated in the T1, T2, T3, and depending on which one you participated in, it often determines whether you love or hate Telstra.
So 1 was okay, 3 was okay, 2 not so much.
2 people generally got
$7.40.
Pretty well hammered. They were actually sort of on the move upwards.
Got to $9. They got to 9, like at their peak. GFC, pre-GFC, $9.90 comes to mind.
Yeah.
Anyway.
Yeah, but even recently, sort of they were upward of $6. But a few things starting to sneak through, and you know, this result we saw a similar sort of thing, didn't we? You know, a lot of pressure on revenue and earnings. Probably the only thing that really saved Telstra from a pretty disastrous, number was costs came down a bit as well. But Telstra now in the unenviable position of now earning less per share than what they're now paying out in dividend.
Which is not a good outcome. And you're probably going to mention it next, I'll get in front of you, is it's that government NBN money that's saving them at the moment. So there's 2, and I didn't know this, but there's actually 2 lots of NBN money. There's the chunky NBN money, and the chunky NBN money, some technical terms here this morning, runs out in 2020. But then in 2020 through to 2055, there's another $1 billion a year that Telstra get. As sort of a
loyalty program, even to
annuity, for the want of a better term. And so it's interesting, in the past people had sort of valued sort of Telstra just on its underlying business. They're now valuing Telstra on the basis of this $35 billion annuity that's coming in, which again is not a great thing from a business point of view. No. But you're right, lots of pressure on mobiles, good positioning in the NBN space. They're the number 1 provider, 50% plus 54% of that market. But pretty ordinary result. Trust us, the second half will be better. You and I have heard that before. That just scares us no end when someone says trust us, the second half is better. So I guess the question is buy, hold, sell. The new session here on Dornbush Download, introduced it just now, buy, hold, sell.
Yeah, look, I'm still happy to hold for dividend, Andrew. I think, again, as you say, with the NBN money coming through, looks like the dividend should be maintainable, albeit, again, not a great position that they're in where they're earning less than they're paying out. Telstra's been there before, of course, and, literally it just, bumps their debt up a bit, I suppose, in the short term. Look, longer term, I guess it's anyone's guess, but increasing competition, and probably like most people, you go and pay for your internet or your phone if you still got the old traditional phone, and it's actually one of the costs that continue to keep generally coming down. So unless they can get some big efficiencies or come up with some great new butte sort of option, revenue is going to be under pressure for a fair while. But look, if the dividend's maintainable, 6.5% on the current price, franking on top,
9% grossed up.
Yeah.
It's a hold.
Absolutely.
Okay, so that's Telstra. BHP result came out last night. Beat expectations by far. Probably the big thing was free cash flow. They're expecting $3 billion of free cash flow, came in at $5.8 billion. So, in other words, all that, talk about Telstra being a cost out story, all those costs that Mackenzie's been ripping out of that business over the last 2-3 years is really starting to bear fruit. Iron ore price over $90 a tonne. Some of these Chinese steel mills being closed down, higher cost Brazilian imports not being able to compete. So again, it all looks like it's all systems go for BHP. Dividend back up. What's the dividend now? 40 cents US for the half year compared to 18 cents. So a 50% payout ratio. So BHP, buy, hold, sell?
Look, I'm still a buyer of commodity stocks. I think there's still a bit left in them. And I think we spoke about it a couple of weeks ago. We knew that the likes of BHP and Rio were going to come out with some pretty impressive numbers with this, sort of upside in the commodity pricing that's been happening over the last 12 months. Look, I think they've probably still got a little bit left in them. Okay. There's always a caveat to that, of course. Very cyclical stocks, anything in mining. So when the times are good, they're performing well and shooting the lights out. But of course, it doesn't take much for them to, to dip away. But maybe worth adding a few more. But if there's a bit of profit there, taking a bit off the table at times.
So your preferred exposure: BHP, Rio, Fortescue.
Oh, look, BHP is certainly more diversified. Iron ore is still a big part of BHP, but, it's got copper, it's got oil and gas, uranium, a few other bits and pieces, so much more spread out. Rio is basically iron ore these days. 85%, I think, is iron ore for Rio. A bit of aluminium, diamonds, but and of course Fortescue is really all iron ore. So if you believe in the iron ore story, you'd go Fortescue. But of course you've got pretty much all your eggs in the iron ore basket. Bit more diversity. You'd go BHP.
And Fortescue have been madly paying down debt, and I think they're increasing their dividend to 40 odd cents. I thought I saw this year. Yeah. So on a $7 share. So again, who would have thought Fortescue almost a dividend payer?
Oh, look, Fortescue's had a massive restructure. I know when
share prices come up.
Yeah, when they were cost cutting. I mean, they got the cost of production down to about $15 a tonne when the price of iron ore, fell back to 30. So, if they can keep those sort of metrics with, as you say, iron ore now back to $80, $90, there's a fair bit of cream in there for Fortescue. Yeah. But a bit of that's built into the share price now, of course. It's had a really strong rally and it's trading on pretty high PEs. But assuming that the underlying commodity prices can remain robust, you'd have to think there's still probably a bit of blue sky ahead for Fortescue.
Yeah, and like you're saying, that one's probably more of a, dare I say, speculative, one-trick pony, whereas like a BHP, you do have that more diversified spread. We'll briefly touch on, because we're starting to run long, briefly touch on a couple of the ones that didn't perform so well in profit reporting. Brambles. Brambles sort of warned the market their result was going to be ordinary, so the share price fell away, and then they came out with an even worse result. And so the big stick came out back into the nines. Dan, with his technical analysis and looking at owl entrails and the dartboard out the back, he thinks around $7 is probably the place to be buying those. And Dan's usually pretty spot on with that type of stuff. Probably the key takeaway, and we mentioned this last week, is around Amazon. Amazon back again. Retailers are not buying pallets of stuff anymore. They're only buying odd bits and pieces because consumers only want odd bits and pieces, and it's sort of almost Amazon being the distribution centre, and it's sort of cutting out the need for pallets. So Brambles, buy, hold, sell. It's probably a buy if it keeps on falling away. It's certainly not a sell at these levels. Not that we've really got many clients in Brambles, to be honest. And Worley Parsons.
Yeah, no, Worley has struggled for numerous years, and basically in the construction engineering game, servicing game, particularly with the energy sector. Result wasn't great the other day. I think the price dropped 8 or 9%. On the flip side, Monadelphous Group, which is one that we've liked for a while, and it's sort of ebbed and flowed as the mining sector has. It came out with a result that beat expectations.
Share price up 12% on the back of it. And it's interesting you brought up Monadelphous because they operate in similar spaces. Worley Parsons is woe is me, things are terrible, things are challenging. Monadelphous, gee, there's lots of opportunities out there. We can't wait to get into it.
Yeah.
Both looking at the same market, different views, and the share market's sort of backing more the Monadelphous view than the Worley view. The other thing with Worley is they've got debt, and there's a view that, you know, they in fact may need to go out and issue more shares to help pay down that debt. So, yeah, that Monadelphous result was a good one, and as you said, the share market reacting positively. And it still pays a pretty good dividend, doesn't it?
It does, yeah. It's paid a dividend pretty much all the way through. So, yeah, it's amazing just how much the sentiment of the market can affect the prices. You know, we see it all the time that a company that you sort of think should be doing a bit better doesn't, or sometimes you look at it and think, gee, that company's doing well. I don't think it should be. So, but yeah, no, a lot of sentiment in it, and of course that servicing construction sector has, you know, has copped it in the last few years. But there's certainly been some good upside, and you know, Cimic's another one that's also come out with some good numbers and seen a bit of a, you know, bit of a benefit there.
The former latents for those playing at home. I think probably the final takeaway is, you know, we're talking about how to play the resource or the materials sector. We've sort of given you another way around that sort of mining services play as well. There are other ways of playing that, but again, be very careful, because those mining services ones, when commodities turn down, what's the first thing that gets the chop? The mining services side.
Yeah, absolutely. Yeah, the cyclical nature makes them, potato at times for sure.
But when it's good, things are fantastic. Anyway, till next week.
Thank you.